It's Fed Day, and my next guest says there's still enough fear in this market for gold bulls to remain comfortable. Peter Hug joins us now. Peter, good to see you.
It's good to be here again.
Peter, before we talk gold, I know you were a panelist at the world's largest ETF conference in Florida over the weekend. How was the show?
It was extremely well attended, given the fact that, the commodity complex has sort of been on a down leg for the past 2 years. Normally, when that happens, you'd expect attendance at, a commodities conference to be down, but it was actually up 30%. There were some 1,800 delegates there. It was very well attended, and all the big players and money managers and traders were there as well.
Well, Peter, I'm glad to have you back so we can talk gold, which reacted positively to the weaker durable good numbers that we saw on Tuesday. Gold closed below 1,300. We're still below 1,300 as we speak. But what do you make of the economic data that came out yesterday and gold's reaction?
Well, yeah, I still think the U.S. is on course this year to come in probably with an average GDP number somewhere in around the 3% level. I think you need to look at the macro picture here when we're looking at gold. And this came out very forcibly at the conference yesterday, not only in the panels that I participated in, but with some of the keynote speakers. And, logically, you would see a stronger dollar, you would expect weaker gold prices. But, these money managers are looking at this now on a more macro level, and they're looking at Europe, they're looking at negative yields. In some of the strongest currencies, the Swiss franc, German bond yields 5 years out are negative, and people are searching for yield, and they're scared, and some of that capital is being redeployed into the commodity market, notwithstanding the stronger dollar. You've got significant physical buying that continues in Europe on the expectation that the euro is. After this recent bounce based on just some profit taking, probably headed towards the parity level against the dollar.
All right, Peter, let's talk Fed Day now. And a senior economist at Morgan Stanley recently said that she doesn't see the Fed pulling the trigger on rates anytime soon. In fact, not before March 2016. Now, I've spoken to a lot of analysts who have echoed this view, saying that the Fed just doesn't have to raise rates given the current state of the global economy and because the U.S. currently has the highest rates. Peter, do you agree? Can anything out of the ordinary emerge from today's meeting?
Today, I don't think they'll do anything, and I think what's important today is to watch their language. If they start to tie their decisions going forward not only on domestic policy, which has been their mantra, looking at unemployment and looking at inflation rates in the United States, but they start to tie it to global events. We've been in the camp that the Fed is very unlikely to raise rates in 2015. We've been in the camp for the past 4 or 5 months suggesting that 2016 would be probably a more normal time frame. Given that the Europeans have just put in €1 trillion of liquidity into the market beginning in March over the next year with negative interest rates in Europe, zero rates in Japan, it just doesn't make sense to me for the Fed to step in and raise rates. I mean, the dollar is going to go up without them having to do that. And I just think the Fed is going to take into consideration what's happening globally. And in that context, I agree that a rate increase on the Fed is probably not likely until 2016.
All right, good thoughts, Peter. Finally, we have GDP out on Friday. Any surprises here, you think?
No, I think the number will come in probably a little higher than 3. I think U.S. growth is going to be between 2.5, 3.5 coming into for the balance of 2015, assuming no major shocks coming out of Europe. The lower oil prices is going to help the GDP number probably first quarter this year. And so I think it's, steady as far as the U.S. goes. And, it's very critical, though, that the equity markets, not only in North America, but also Europe, pick up on this ECB monetary easing and grab some lift. If they don't grab any lift, I think there's going to be more deployment of capital into safe haven plays, specifically gold.
Peter, thanks so much for your thoughts and have a great Super Bowl Sunday. We'll see you next week and we'll see you tomorrow. Thanks for watching.